a rising uranium spot price, a site that could be in production as soon as 2025 if it all goes to plan, a multi-decade mining strategy, and investing and strengthening the relationships of the local communities in which they operate. I'm Shay Russell, and welcome back to Cocktails and Commodities, the resource podcast where macro analysis meets mining insights. Of course, you'll hit the like button because you like learning about all things uranium and resources, but please remember all information in this podcast is general in nature and not financial advice. Joining me in the digital studio today is Keith Bowes, Managing Director of Lotus Resources. Keith, how are you today?
Very well, thank you, Shay. Nice to see you again.
It's wonderful to speak with you and have you on. And I've got to say, what a time to be in uranium. We're having our chat at a very premium time when uranium, the spot price is absolutely flying higher.
Correct. I think $86 today when I last looked, which puts it as the highest since probably 2008, I think, is sort of what people are saying. It's absolutely phenomenal what's happened over the last couple of months. I mean, as I've been in the uranium industry, probably not as long as some of the others, but when I started in 2015, 2016 or so, the story was next year, the uranium price will run, and finally we've got there.
You have. Now, the problem with these interviews is I'm a curious person and people will reveal interesting tidbits about themselves and we accidentally fall down rabbit holes. Before we start the interview, what made you move to uranium in 2015? Because it was a very unloved commodity then.
It was an extremely unloved commodity then. But I think there was, at least with the group of people that I was working with, I think already then there was a recognition that uranium was certainly something that was going to be required in the future, whether you talk about energy transition, whether you talk about the growing electricity demand, or whether you talk about the net zero future. I mean, uranium ticks all three of those boxes, and it seems such an obvious choice to get into as a future commodity that will be required to be able to meet those goals. So I think we are slightly ahead of the curve maybe in getting into it, but we were certainly well aware of the issues that everybody's talking about now.
All right, now let's bring this conversation back to what we need to talk about today. And this is what's happening with Lotus Resources. Now, you guys have had a really good year, and you're actually going to have an even better 2024 by the recent merger between Lotus Resources and ACAP. So let's start with some of the assets that you've got under management. What happens now with the two projects that you've got?
So the two projects you've got, so we've got the Kayelekera uranium project, which was the original project that Lotus effectively floated on, which we acquired from Paladin Energy back in March of 2020. That's our primary project. That project, for people who have been in the uranium industry for a little while, will know as a past producing asset. So it operated between 2009 and 2014 and was effectively put into care and maintenance back in 2014 due to the crash in the uranium price post Fukushima. So Paladin Energy kept it in care and maintenance, and we effectively approached Paladin Energy in 2019 and made an offer to acquire the asset off them, which was successful. And our ownership started in March of 2020, and we've kept it on care and maintenance since then, but have been doing a lot of work in the background in terms of the strategy and optimization of the processing plant and the mining facility, how we could bring this mine back online again in a higher uranium price, obviously, but also to ensure that we'd optimize the process and got that cash cost down as low as possible. So that's been our focus for quite a while. But as you've mentioned, we've just recently closed off the merger with ACAP. And through that merger with ACAP, we've acquired the Letlhakane uranium project, which is located in Botswana. Now, what attracted us to Letlhakane was, first of all, its very large resource. It's got 190 million pounds of uranium in a JORC-compliant resource. And if you were to compare that against Kayelekera, Kayelekera sits at around 51 million pounds of uranium. Ooh. So a substantially larger resource associated with Letlhakane, but it is a greenfield project. So we still need to go through all of the technical programs, feasibility studies, and those types of things before we would move into actually building a plant there. So it is a much longer term project for us, but having a much larger resource there means there's a much longer life of project compared to Kayelekera. So we see those two projects merging together very, very well, and that it's a lot easier and a lot lower cost for us to bring Kayelekera back online again because the plants and all the associated infrastructure already exists. And then look at potentially using some of the profit generated from Kayelekera to then be able to develop the Letlhakane project, which is then a sort of 15 to 20-year life of mine project associated with it.
So, correct me if I'm wrong, but Kayelekera, that was actually quite a low cost producer to begin with, wasn't it? And will it still be a low cost producer when it comes back online?
So it did have some initial issues when the mine started up. So it was running at probably around $50 per pound when the mine started up. However,
This was while it was
Paladin,
not under your ownership, though.
this is not under
Yeah.
our ownership. So this was when Paladin was operating it in 2009, 2010, 2011. Around 2012, they did a massive optimization program. They really focused on what was hurting them from a perspective. And they were very, very successful in that optimization program and managed to get their cash cost down to about $35 per pound. Okay. So $35 per pound, it's a good price to be operating at. It's not in the lowest quartile because you do have these in situ recovery projects out there, of which Kazakhstan is obviously the key producer of that. Those are really low cost producers, as well as some of the really high grade mines up in the Athabasca Basin in Canada, also low cost producers as well. But $35 per pound sort of put them in the second quartile of the cost curve, which was a very, very comfortable position for them to be in. But even at that price, when the Fukushima happened and the spot price crashed, they weren't economic. But what we've been able to do since we've acquired the asset, we've focused even more on some of these key um, areas that are impacting on the cash cost. Things like connecting the plant to the national grid rather than using diesel gensets, looking at things like acid recovery, looking at things like ore sorting to improve grades and all that kind of stuff. So we really spent a long time looking at those various areas, and we put together our feasibility study last year, which actually demonstrated that we could achieve a cash cost of around $29 per pound. So
Oh,
even lower than what they were operating at, because we've been able to do things, as I mentioned, like connect to the national grid and reduce our power costs significantly. So that $29 per pound puts us very comfortably into the second quartile, and we're very, very confident that we can operate the mine economically at that sort of cash cost.
tell me, it's sort of a bit of a seller's market at the moment when it comes to offtake agreements and securing supply. I'm hearing plenty of stories that a lot of uranium supply is locked up for the next couple of years. Now, I believe Kayelekera is due to come online sometime in 2025. Are you finding that there is a hungry customer at your end?
There is a very, very hungry customer at our end. I think when we started talking to some of the utilities, probably about 18 months ago or so, was really a case of us approaching the utilities and trying to negotiate with them, or at least introduce the project to them. I certainly felt at least since the World Nuclear Association's conference in London in September, we've actually had a lot more of the utilities making the approaches to us to understand where Kayelekera is. And as you said, when is it going to come back online again? Because 2025 and certainly 2026 are the years when a lot of the utilities out there are starting to have a gap in their coverage. So they haven't bought all their uranium that's required for them to be able to operate their reactors in 2026 and certainly beyond that as well. So we've had a lot of inbound inquiries, let's say, over the last couple of months, which has been fantastic for us.
Obviously, you can't give away any trade secrets just yet, so I am very excited to see what news comes out on the customer front. But tell me, I did throw out 2025 as a possible time to production. Now, you still have more work to do before you get there, and obviously these things can be a bit of a moving target. But how is that timeline looking?
So the way we're looking at it at the moment, obviously, what all companies are looking for in terms of being able to, let's say, to be more certain around their production profile or production start dates and all that kind of stuff, is this final investment decision. So that's when you try and get all your ducks in a row to say, right, we're ready to go now. We can start to spend the money that's required, in our case, to refurbish the plant, to start recruitment and all that kind of stuff. So in order for us to make this final investment decision, there's been a couple of things that we've been looking at. The one of them, which was out of our control, was obviously the uranium price. But obviously, the uranium price is now at a level where we're very, very comfortable to be able to make final investment decision. Although there are some other things that we need. So, for example, I mentioned in our cost-cutting exercises that we did, we're looking at connecting to the national grid. So that's not a simple process for us. We do have to construct transmission lines and do upgrades to substations on the Malawian network and all that kind of stuff. So we're busy negotiating with the Malawian electricity utility about connecting to the grid, about a power supply agreement, a power implementation agreement, and all those types of things. So we'd like to get those advanced before we make final investment decision to get more certainty around the timeline associated with that, but also the tariffs that we're going to be using or that Eskom will give us when we start operating the mine. So that's a really important part of our cost structure. We also want to have a look at things like, obviously, we're discussing or negotiating with the government what we call a mine development agreement. So in Africa, a mine development agreement is a fairly common thing that you negotiate with the government. And what that does is it allows you to set the fiscal regime in which the project will operate. So you're normally seeking some concessions from the government, whether that be around taxes or something like that, whether that be around duties and tariffs on imported items and all those types of things. And that's really just to try and support the investment in the country moving forward. So we're busy negotiating that with the government, and I've actually just come back from a trip to Malawi where I've met with various officials in the government to move that negotiation forward. We've had some good success over the last couple of days. I think we're on a very, very good path in terms of coming to a final result for that, and hopefully we'll be able to talk about that in the first quarter of next year as well. So those are two really important things from a negotiation perspective. We also recognize at the same time that the feasibility study that I mentioned that indicated that we could operate at $29 per pound is a little bit over a year old. I think it's important for us to go and do a bit of a refresh on that, but do it more as what we call a front-end engineering and design program, which would then roll into detailed engineering. And the intention behind the front-end engineering and design program is really to go back and check that $29 per pound, whether that's still a viable cost for us based on the new reagents, new freight costs, and all those types of things. But also we want to go back and check the capital. So one of the big attractions for Kayelekera is a very low capital requirement for us to restart the asset. It's about $88 million of upfront capital required for the refurbishment and for the installation of some of the new equipment we're looking for. Again, we need to go back and check that number as part of the FEED program before we move forward. And then the last thing is our feasibility study demonstrated to us it would take us about 15 months or so to refurbish the plant. As part of the FEED program, we'd like to go back and really just check that timeline and make sure that the 15 months is still a valid period for us to be able to do that. So that's one piece of work we'd like to get done before FID, such that we have much more confidence around the cost structure we're going to be working with moving forward. We also, of course, would like to be able to announce signing an offtake or a couple of offtakes, I think, with some North American utilities or European utilities. I think that would be really useful. We'll certainly demonstrate to the market that the uranium industry is taking us seriously. And with the prices where they are today, I think we can lock in a contract that I think will be very, very value accretive for the project moving forward. And then the last thing, of course, is financing. We need to resolve how we're going to manage our financing as well. How are we going to finance that $88 million that we need, as well as the pre-production costs and the working capital, which brings the total funding requirement to about $125 million. Now, whether we do that through debt, whether we do that through equity, or whether we do that through prepayments or some other form of financing, we're not sure at the moment. We've got some ideas of how we want to do it, but I think there's a bit more work required around that to get the final financing strategy in place.
I love the transparency that you've put forward on what the company is working towards. Too often, shareholders are left in the dark on what direction a company is moving at, aside from, a couple of colourful bullet points on a presentation. But you've outlined the steps that need to be taken and, what are the roadblocks that you've got to work through each time. So that's fantastic to hear from a management point of view where you're working across. But I just want to bring it back to something that not all shareholders will be familiar with. And you dropped the location of the project, and that is it's in Malawi. Now, not a lot of Australian investors are familiar with this part of the world as a uranium province. And let's be honest too, there are some African countries that do end up in the news because their governments start out mining friendly and end up not so mining friendly. Niger is one of those ones that rings a bell. But Malawi has a more democratic style of government, don't they? Like the sovereign risk here is quite reduced.
I think it is. It's a previous British colony and used to be called Nyasaland. Independence 1967, if I remember correctly. Malawi, it's got a democratically elected government, as you said. It is, I suppose, if you were to look at it, is primarily Western focused. Malawi, unfortunately, is a very poor country. Probably competes against the likes of Yemen and those types of places to be one of the poorest countries in the world. It does rely a lot on donor money. And a lot of that donor money comes in from either the European Union, from the UK, or from the US. So, in that perspective, it is quite Western focused in terms of the way it does stuff, which I think some investors would see very, very positively as a destination to be able to invest in. But just as you talk about Malawi and what it's like as a mining jurisdiction, you rightly pointed out it's not a well known mining jurisdiction. In fact, the Kayelekera mine, when it operated in that period from 2009 to 2014, is in fact the only commercial scale mine that has ever operated there. There is no commercial scale operation at the moment. And when Kayelekera restarts again, as we said, hopefully in 2025, they will be the first mine to come, or commercial scale mine to be operating there again. But there are a lot of other projects that other companies are looking at in Malawi that I think will come online in the next few years. And I can throw a few names out there. Sovereign Metals has got a retail project there, probably one of the best retail projects in the world. They spun out their graphite assets into a company called NGX. Macango Resources, which is a Canadian company, has got a very, very good rare earths project there. Lindian Resources, which is another ASX company there, has also got a rare earth project there. Globe Metals has got a critical metals project there as well. So there's a lot of projects that are potentially coming online in the next couple of years that will really establish the mining industry within Malawi. And Malawi, as a country, where they look at where they are now and where they want to be, they're obviously looking at ways to be able to grow their economy and all that. And although they were previously a very strong agricultural-based economy, with tobacco being their main export, they are certainly very much focused on the mining industry as being the new industry that they're going to be relying on to grow their economy. So they are very, very supportive of mining projects coming back online again. And that's why we've been able to have these successful negotiations with them around the MDA, because they are supportive. They recognize the benefit of what a mine like Kayelekera can do from employment perspective, but also importantly from foreign exchange and also revenue for the government as well.
It's good to see that you've been able to further your relationships with the Malawian government, and obviously that's helping you progress this project at an appropriate speed and also connecting it to the grid as well, because no doubt that's the kind of infrastructure the government wants to support, isn't it? That permanency of mining in the industry, in the area.
Exactly right. And one of the things that we are negotiating with the Malawian utility, and why it's important we get these agreements in place, is that we will actually provide the funding for this upgrade to the electricity system. So we will pay for the upgrades to the substation, we will pay for the transmission line to be installed, and then hand that infrastructure over to the Malawian utility for them to then maintain and operate. But of course, in order for us to be able to do that, we are expecting to get a reduction in the tariffs that we pay for the electricity, so we can recover our capital costs as we move forward. So yes, it's important. Not only are we going to be there mining, providing employment, but we're also going to be supporting the further development of the infrastructure within the area.
Now, I want to touch on something you mentioned earlier about your thanks to the merger, the long life asset you've now got in Botswana. So now with the Kayelekera mine, as you said, you're looking at you're redeveloping it for the moment. What's the mine life that we can expect out of Kayelekera? And then how are you going to progress the new asset you've got in Botswana?
So Kayelekera at the moment, if you look at our feasibility study, shows a 10-year life of mine. But I think if you have a look at the production profile there, the first 7 years of production coming out of Kayelekera are very strong. That's sort of 2.4 to 2.5 million pounds per annum. But after year 7, we actually have depleted all of the ore from the pit, and we then start to taking or treating material on the stockpiles, of which the grade is obviously a lot lower. That means that our production profile drops off to about 1.2 to 1.4 million pounds per annum. So when we were first looking at opportunities to try and extend at least Lotus's production profile, one of the things we obviously had to look at was exploration around the Kayelekera asset. So within the mining license, we did a lot of exploration work, and we were able to grow the resource from when we originally acquired it. But I don't think there's a great deal of more uranium available around the pit. We do have a number of exploration licenses in Malawi, and we have done some exploration on those. We've been very successful on one of them called Livingstonia, and we've actually been able to put a small resource there of about £5 million on the Livingstonia exploration tenement, and we can see that as a future satellite pit that we could operate. And then with the technology that we're looking at Kayelekera for upgrading the ore, this ore sorting technology, we could put in a very simple crushing and ore sorting plant to produce a concentrate that we then ship to Kayelekera, or truck to Kayelekera rather, for retreatment. I think that's what we're going to be focused on there, to try and grow that life of mine past the 10 years, or alternatively to try and fill in the gaps in that year 8, 9, and 10 where we've got that lower production profile as well. So we will continue to do exploration at Kayelekera and on the exploration tenements we have. There's another one where we've got some mineralization that we would like to follow up on called Chilumba. That's right next door to Livingstonia. Potentially another satellite pit that we could bring into the production profile as well. So though we talk about 10 years at Kayelekera, I do think there is an opportunity for us to extend that further. Maybe it's 12, maybe it's 13-year life of mine. But certainly from a company perspective, when you look from a longer term strategy, how are we going to be producing the bulk of our uranium? Well, we think that's going to come from Letlhakane. As I mentioned, Letlhakane is 190 million pounds of uranium at the moment. A lot of that's in the inferred status, 78% inferred, 28% measured and indicated. So we need to upgrade that. But I still think, looking at that very large resource, that we should end up with something of a reserve when we get to that point. Sort of, I would think around 100 million pounds wouldn't be, a target that would be unachievable for us. And 100 million pound reserve, I mean, that could give us 20 years at 5 million pounds or something like that. I mean, there's a really big opportunity out there. We've obviously got a lot of technical work we need to do around it, but the prize is that sort of 20 years at 5 million pounds, I think.
Yeah, look, that's looking quite far ahead, but as I said, this gives you an indication of the direction of where management's thinking, working one pit and then moving over to extend what is a multi-decade, has the potential to be a multi-decade asset. Now, our time here is drawing to a close, and I have two final questions for you. One's for fun, one's for work. Keith, one of the things I want to know most is what's probably the best kept secret about Lotus Resources right now?
It's a really good question, that is.
What is it that shareholders are missing from this story? Because obviously you've been in the headlines for the merger, which has been a huge success, so congratulations. You're extending the life of what will be a low-cost producer in an area that is an up-and-coming mining jurisdiction.
Yeah, one of the things that I think we're really proud of, let's say, that we do try and put out into the market is really a lot of the work we're doing with the communities, maybe, I think is something we're really proud of. I think when we first took over the asset in 2020, there was a lot of negativity, perhaps from some of the communities with what was going to happen to the mine. We've spent a lot of time and a lot of effort working with the local communities, so especially the village, the Kayelekera village, after which the mine is actually named, which is just on our doorstep, but also 3 or 4 other villages that are within close proximity, in terms of working with them and trying to support them. But we've also extended that out to the wider area as well. And one of the things we've done, which I'm really happy with, is we've built up an incredibly good relationship with what they call the Paramount Chief in Malawi. So this is the Paramount Chief whose lands cover northern Malawi and actually extend into Tanzania as well. Built up a really good relationship with him, and he is very, very positive about our presence there and very, very supportive in terms of the mine starting up. I think having those relationships with the communities and having a relationship with someone like a Paramount Chief, I think will smooth over a lot of the problems that perhaps some mines have when they restart. And I think that's really, really important as we sort of get into the operations and get into the production profile. I think that's one side of it. The other thing that maybe people won't recognize too much on is that when we talk about our plant and our production profile and all that, we do think we can ramp this plant up relatively quickly, especially if you were to compare it to a greenfield project. For example, we already know the plant has been debottlenecked. We know it can operate at 3 million pounds per annum. We're only targeting 2.5 million pounds per annum. We already have 1 year's worth of ore sitting on the ROM pad waiting to be fed into the plant. We're not going to be constrained from our mining schedule in terms of the startup of that plant. So we're hoping we can ramp this plant up pretty quickly. And of course, as I mentioned, with our community work, we're hoping that we're not going to have any issues with communities or anything like that when we start the mine up.
I really like that because look, obviously, from multi decades, many decades ago, mining got a bad rap, but it is great to hear that there is such a proactive approach to working with local communities because, as anybody in mining knows, it's now the local communities are key to making sure that these projects run smoothly. So that sort of approach, making sure you've got good relationships and working with locals, is fantastic to hear. And I don't think mining companies get enough attention for the good work they do with local communities. So thank you very much for sharing that. That was for everybody listening. I was not expecting that answer. So thank you very much for that, Keith. It's good to hear. But our time must draw to a close. And I do have one more question for you before you leave cocktails and commodities today. We have done the commodity part of our conversation. However, seeing as it is the time of year where people may partake in the silly season, tell me, Keith, if I was at a bar in Perth right now, what cocktail would I be buying you?
Whiskey sour.
Oh, good. Yes, my favorite. Do you have a favorite whiskey?
I do like my Irish whiskey, I must admit.
Excellent. Well, I would
Yeah,
have no problem buying you a whiskey sour if we were ever in a bar. Keith, I've just got to say thank you very much for today's conversation. I look forward to Lotus's progress next year and hearing more about it.
excellent. Thank you very much.
Now is a great time to be in uranium, so make sure you head over to Lotus Resources website so you can follow their progress over 2024. That's it for this episode of Cocktails and Commodities. Of course, make sure you're following this podcast so you always know what stocks are making news, which commodities are moving markets, and the companies trying to get it out of the ground.